Hi everyone, welcome back to Be Rich. Ta-da! I have Shashwat with me. I pulled him away from his busy schedule of studying and trying to finish his course as he's reached the last leg of his course. So I pulled the running man away from his course and I told him, please join me for a few minutes. I've been doing these relentless videos one after another all by myself. I said people are sick and tired of seeing my beautiful face. They want someone else. So who's better than Shashwat? I can't think of anybody else. So Shashwat, what do you have to share with us today?
I figured the first topic we'd probably, be good to talk about was investment in cash because this is something which we've covered on the channel before, and we've also talked about being invested in cash being a great opportunity in the past year. But times have changed, as Bob Dylan's song goes. The times are changing. So let's see
Yes.
what we have in store for the upcoming year and the past few months, which have been certainly different from what we'd seen before. So, one thing which we saw with the past year was that interest rates were hiked up. From 2022 till early 2023, we saw interest rate hikes in the US, and that made it so that investing in the US dollar made a lot of sense, being invested in cash. And if you held the Indian rupee, it also made sense to be liquid because with climbing interest rates, you would definitely see FIIs pull out, which meant that your market should take a hit. However, the Federal Reserve ended up signal cutting rates a little earlier than we expected, and they switched from a hawkish to a dovish stance very quickly, or quicker than we expected, and that's basically meant that again things have changed, and as the facts change, our opinions have to change. So let's see what
Correct.
some of the important statistics have been for the past year. And because this is supposed to be an international channel, I'm going to refer strictly to US markets to get a global feel for it. So when we look at the data abroad, we see that the NASDAQ over the past year has done considerably well. It's increased by nearly 40% over 1 year, and it's outpaced the S&P by over 20% or so. And the UK remains a laggard, Europe remains laggard compared to US stock markets. And you have seven big companies in the US which have done really well. And these seven companies are basically Apple, Microsoft, Alphabet, Amazon, Tesla, Facebook, and Nvidia. And these companies are known as the Majestic Seven, as they have been dubbed. And these companies have performed very well from the AI boom, and they've basically pulled up the Nasdaq's performance compared to the S&P 500. So, all this being said, does it still make sense to invest in cash? So this or hold money in cash. So let's look at this argument. The argument here now is that with interest rates coming down, it may make more sense to lock in your returns in long-term bonds because then you'll be able to hold on to high interest rate returns, pockets of high returns when the interest rate comes down. And when the interest rate comes down, you pretty much have all your yields on bonds come down, which means that your real returns on these assets aren't very much. So you aren't really outpacing inflation. But this wasn't the case before because you were getting about 5% on short term treasuries before the rate cuts or a dovish stance was announced by the Fed. So now it makes more sense for you to maybe pivot into equities slowly. And that's what we've been seeing in the world with a lot of people pivoting to equity markets rather than staying in cash or in short term bonds. And however, a word of warning or a word of caution, which is that you have to be very careful and picky and choosy with what kind of stocks you want to get into because you valuation matters and that you can't just throw it outside the window and say okay, we'll be fine. And the US is not through the woods yet. We don't know whether inflation is entrenched or not. It's pointing towards transitory, but we're not really sure about that. So that being said, yes, there is a case to be made for heavier investment in equities. It may not be a slam dunk, open and shut case where you basically say, okay, cash is not useful anymore. So that's something to keep in mind. And secondly, in the New Year video, which we talked about, gold was seen as one of the avenues. And gold can be a substitute for cash when the US dollar is now depreciating. So when the US dollar depreciates because interest rates come down, gold ends up performing better, which is why gold ends up becoming an asset to look for or look at during a period of interest rate cuts. This is another avenue which is a cash substitute which people can look at. substitute in the sense that it's a very liquid asset which you can look at. So these are some of the important trends in terms of holding cash in during this period. And we've always espoused on this channel, or rather, in our discussions, we always talk about investing and SIPing in the Nifty 50 and S&P 500, regardless of what's happening abroad. And that's always been something which we have done, and it's something we've discussed a plentiful amount of times on this channel. So if you're doing these things, you shouldn't even care about what's happening with interest rates or not, because at the end of the day, as long as you're investing for the long term, you should be rest assured that the equity markets will do just fine. So what do
True.
you think about this?
I agree with everything what you said. And all things considered, the strategy of what even my brother has been mentioning and Shashwath is saying, buying these bonds which are high yield right now prove to be very valuable in the long run. Because at average, anyway, if you're talking about the Indian context, the Nifty at an average gives 12 to 13% over a period of long term, let's say 10 years or more. And if you're
You're
able to pick
being
up a bond,
you're being quite generous with that number.
okay, what number should you
Yeah,
say?
maybe 10%. 10% is a good number.
Okay, 10% is what Nifty is giving. Shashwat is saying in the long term, I'm being generous. I shouldn't be generous. I should be realistic. So 10% seems to be more towards what the real number is, what Shashwat is saying. In the long term, Nifty is giving that. So if you're able to pick up a bond which is offering that same return and your capital is safe, it's a brilliant thing to pick up. And one beautiful thing is the returns from the bond which you get on yearly or quarterly or whatever you've taking that and pumping it into value picking good stocks or allowing that cash to pool to wait for those, like Peter Lynch says, 10% correction once in every 2 years, you'll get a 10% correction in the market. At that time, moving in would make a lot of sense. And even if you take stocks which are considered highly overvalued, but if you look at it over any of these stocks which are considered highly overvalued right now, and you stretch it over a period of 10 years and look at it, you still see good returns. Some stocks give fantastic returns, like Trent, for example, might give some fantabulous returns because from in 3-digit numbers has gone to 4-digit numbers. But other stocks which are like ITC will still give very good returns. Might not be in comparison to Trent, but it still offers you would have doubled or at least tripled your money, which is still a very great thing to do in a 10-year spread. And all this is a great strategy to do as long as, like Shashwat says, you don't worry about macroeconomics, you don't worry about interest rate cycles, you don't even worry about geopolitical things like tension, what's happening in Middle East, and you don't focus on all this. And you just put your head in the ground and make sure the 4 or 5 companies you decide to invest into are safe in the environment they're in. And if there's any cause these macroeconomics or geo situations are affecting those companies, that's the only time you have to really consider it and study it. So I'm in complete agreement with what Shashwat is saying. And right now, the current environment where interest rates are at, it is the best strategy to follow in terms of
Right.
investing long term, value investing. And that's what we have been always professing on this channel is to value invest. We don't encourage trading or anything else.
Yeah. And another thing to keep in mind is that even though the Nifty hasn't done so well in the past 10 years as you would have wanted it to, it will definitely do much better in the upcoming decades, and so on and so forth. Because if you look at the period between 2000 and 2010, the Nifty did exceptionally well. And the period between 2010 and 2020 has been mired in a lot of geopolitical issues, with which we've seen the Nifty sort of teeter here and there in terms of return. So if you change the starting point and ending point of your measurement, the results vary drastically, which is why I
True.
said maybe having a lower estimate on the growth is a little better to sort of
No, I
look at.
completely agree. Yeah, I
But
completely
that being
agree.
said, there is room for cautious optimism in the future, where you can expect the the performance of your markets to do much better, hopefully, and you can cash in on that just by buying a cross section of India through investing by SIP, and
Correct.
you wouldn't feel the pinch either, because you're just investing a small portion of your income every month, something you wouldn't even miss.
True. India is poised for some serious growth. Even if we have a bit of political turbulence, I don't see that impeding our growth, and our potentiality to growth is also going to be exceptional because of the reasons of what's happening in China, not because of geopolitical situation. Just economically, China is going through a churn, and that churn which has started in China, I think that cycle will run at least for another couple of years. before they take a turn towards the better. And all that time, it's going to be good times for India.
Definitely.
So, anything else you want to add, Shashwat?
Only thing is that we're not SEBI registered investment advisors. So
Yes.
yeah,
Yes, we are not SEBI registered advisors. We are not investing advisors. These are just purely intellectual conversations an uncle and a nephew are having, which we are sharing with you. And if you feel that it adds value to your life and your investment and where you want to think where your money should go, we're more than happy to share these conversations with you. Thanks for joining us on Be Rich today. I hope you enjoy the video, and I'll try and pull in Shashwat much more often, or as much as he allows me to. Thank you.
thank you.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.